Welcome to Warehouse Property Finance. I'm Georgina, and this is the show where we explain how money actually flows into UK warehouse, industrial and logistics property in plain English for investors, developers and owner-occupiers. Today we are setting the scene for 2026, how these assets get funded, what the numbers look like right now and what the market is telling us. Let's start with the backdrop. The Bank of England base rate is 3.75%, held since the cut in December 2025. That matters because industrial debt is almost always priced as a margin over base rate, so a steady base rate gives everyone a firmer anchor for planning. On the property side, the picture is solid. Knight Frank puts prime distribution yields at around 5%, with national vacancy around 7% at the end of 2025. And prime rents have kept growing, up roughly 4 to 5% over the year on JLL and Knight Frank numbers. Industrial has been one of the most sought-after asset classes in the country, and the lending appetite reflects that. Now here is the single most important idea in warehouse finance. An industrial asset is financed on the asset and its income. For a let investment, the loan is driven by the tenant, the lease and the rent. The questions a lender asks are: how strong is the tenant covenant? How long is the income? What is the WAULT, the weighted average unexpired lease term? And does the rent cover the interest at a stress rate? That last test, the interest cover ratio, is commonly set around 1.3 to 1.6 times. Loan to value is only half the test, cover is the other half. That income focus shapes every funding route, so let's walk through the main ones. First, purchase and investment finance, for buying a let or part-let warehouse. Senior investment debt for a well-let asset currently sits broadly between 6 and 8% all in, with loan to value typically around 60 to 75%, depending on the covenant and the lease. Prime long-let big box with a strong tenant sits at the keen end. Multi-let estates, shorter leases or weaker covenants sit higher. Second, owner-occupier finance, where the business buys its own unit. That is read more like a business, on the trading covenant and EBITDA cover, with a commercial mortgage typically up to around 70 to 75% loan to value. Third, development and logistics build finance. Here lenders size against cost and against gross development value, usually around 60 to 70% of cost and up to 60 to 65% of end value, with interest rolled up over the build. This is where the supply picture matters. Savills has speculative space under construction down around 65% from the peak, at roughly 7.6 million square feet, and Knight Frank puts recent completions near 16 million square feet. Less new supply supports values on existing stock, but lenders lean hard on pre-lets and a credible exit. Fourth, bridging finance for speed-led and transitional situations. Auctions, vacant possession, fast purchases, or carrying a part-let unit toward a refinance. Bridging is short-term, commonly priced around 0.65 to 1% a month, on terms up to 12 to 18 months, and it always needs a clear exit, usually a refinance onto term debt, a lease-up, or a sale. Fifth, refinance and stabilisation loans. As facilities mature, owners refinance onto new terms, and many release equity from rental reversion. Because prime industrial rents have compounded close to 10% a year over 5 years in places, a higher rent supports a larger loan on the same building. Stabilisation loans bridge a part-let or vacant unit to a stabilised investment refinance once it is let. And then there is multi-let estate and portfolio finance, where a single facility can sit across several assets, with the covenant and the WAULT blended across the portfolio. We have a dedicated guide for each of these. There is one more theme every borrower should have on the radar: energy efficiency. The minimum energy efficiency standards are tightening, and Knight Frank estimates around 128 million square feet of industrial space is at risk by 2027, rising to roughly 404 million square feet, about 60% of stock by 2030. About 82% of pre-2000 stock is currently non-compliant. That retrofit, brown to green, is increasingly funded through development or bridging, then refinanced once the building is compliant and let. It is a real funding event, not just a compliance footnote. If you want the detail, we have built a full set of guides covering warehouse purchase and investment finance, development and logistics finance, refinance and stabilisation loans, owner-occupier versus investor finance, voids, repositioning and retrofit, warehouse bridging, and multi-let and portfolio finance. You can find them linked from this episode and at warehousepropertyfinance.co.uk. One important note before we finish. Everything in this episode is general market commentary, not advice, and not a quote or an offer. The figures are indicative bands for UK warehouse and industrial property, and real terms are always set case by case by individual lenders. Commercial finance on industrial property is unregulated business lending, so do take professional advice for your own situation. That's our 2026 overview. I'm Georgina, this has been Warehouse Property Finance, and we'll see you in the next episode.